Hello and welcome back to another episode of the Lone Star Capital podcast. I think almost a year deep in now, which is crazy to say. We'll get retrospective in the future, maybe when we're in person for next week's recording. But with that said, welcome back to the podcast. Your host, Craig McGrother, the Director of Business Development at Lone Star Capital, alongside the one, the only, co-founder, two-time author, principal of the firm, Rob Beardsley, in Houston as well. How are you today?
I'm good. Excited about this episode.
Yeah, awesome. Well, let's get into housekeeping before we get going. Number one, I'm going to talk about the summit event first because it's going to be a little bit quicker. Our summit event is coming up in September 15th and 16th. If you'd like to come to the event, if you are in the commercial real estate world, if you are an LP investor or capital allocator or institutional capital person, family office, you name it, we would love for you to come to our event. It'll be high class. It'll be well done, as always. It'll be, really the purpose of the event is networking and relationship harvesting. So if you're looking to go to a world-class event, we have an application process. Say you heard about it here on the podcast. If you did, we'd love you to come. Rob, do you have any comments there? Anything we're going to do differently
Nope.
this time around?
Yeah, well, I guess first I'll just kind of run through it in my head. So we've got speed networking, which is definitely a highlight, and that's nothing new. We've been doing that for a couple years now, and that's a must bring back. Differently, we are going to be inviting a lot more sponsors. So if you're an investor listening to this and you've attended previously or are interested in attending, I think the major upgrade this year is that we're really going and trying to broaden our network and bring in best in class operators, not just in multifamily, but in self storage, industrial, hospitality, and just try to bring a more diverse array of sponsors to the event, so that way if an investor of ours or just a general real estate investor comes to the event, they can really get their money's worth, a good bang for your buck, because they're able to meet a lot of great sponsors and grow this network. And for us, there's a benefit too, because if one of our investors attends and meets a good sponsor, we bring goodwill there. We get goodwill from that introduction, and we get the value of just a growing network. And then perhaps sponsors that attend, they have investors that are investing with them in an industrial strategy, and then that same investor is asking that sponsor about multifamily exposure, and then they come our way, right? It's about growing the pie. It's about an abundance mindset, and that's what I'm most looking forward to about at the event.
Yeah, we could also have a sponsor coming that's multifamily that is, maybe exclusively in an area that we don't work in. And we might have investors who say, hey, we love Lone Star, but we're kind of overweight in Texas. And at a certain point, this is too much and we want to diversify. Well, boom, here's a sponsor. Similarly, we're hoping that some of those sponsors as well maybe have investors, capital partners, institutional equity partners that are looking for a Texas relationship, and we can kind of bridge that gap. So to exchange value in that regard is great. Unfortunately, not everyone can spend every dollar with Lone Star, and it would probably be wise at some point to maybe think about giving another sponsor a dollar if you're only with us. Of course, unless you're myself or an employee at Lone Star, it makes too much sense to work and only invest in Lone Star as we can control it. But it makes sense to eventually at some point kind of spread the love around and maybe put a couple dollars elsewhere. And we want to make sure that you, as an investor or a capital allocator, get really great options that we vet and verify to have in the room there. So that's very exciting. It's kind of like the Ascent model to a certain extent, where they kind of audit who's coming, which is really great. Ascent is one of the best events that BizNow puts on, which will be in Miami, which I'll be attending, so it's very exciting there. Additionally, too, if you're going to go to IMN Dana Points in the West Coast or IMN Rhode Island, which is about a week apart, I will be there. I'll be at both of them. We're going bi-coastal. Very excited. So there's a couple more of the events. This year has been really a big push on what events we want to go to moving forward. Where do we want to put our time? What's really the best quality where we can meet a lot of people? So new people, and then also kind of get in front of a lot of our past folks and whatnot. So very excited for those two events. If you're going there, holler at me. Would love to connect with you. Okay, on to the next housekeeping item. You've heard it now 3, 4 weeks in a row. You're gonna hear it probably last time here, but Grand Riviera, our deal in Dallas. If you're a capital allocator or investor looking to learn more about this opportunity, please email me, Craig at lscre.com, and I can send you all the details. We just did a really incredible video on that opportunity, which really showcases the property very nicely. It kind of goes through some of the reasons as to why we're buying a 70s vintage asset deal. We don't really have a big forehead, a tattoo on a forehead saying send us all your 60s, 70s deal. So for us to really want to go forward with an opportunity like that, the juice needs to be worth the squeeze, and this opportunity most certainly does provide that. So we're very excited about this deal. If you want to shed any light as to how you thought the video went, Rob, that'd be great.
Yeah, just to provide a little inside baseball for people, just because my marketing and production brain is at work. We started with these videos and we made them very robust, made them very detailed, and they
20
were
minutes like that.
20 minutes. I mean, and for the Houston 3 pack, it was, I think, 36 minutes. And there's a lot of meat on that bone. There was a lot to go over, but still, that's just way too long. And it was basically a webinar, but in person. And so the data based on the viewer data is that people are only paying attention for about 6 minutes. They're only watching about 6 minutes of the video. So that made me realize that we need to cut down the video and cut out, unfortunately, perhaps some of the meat, but that's not what people are coming for when they're looking at a hype video, when they're looking at the in-person video. If people want all the details, that's what the webinar is for. That's what reading the pitch deck is for, and perhaps getting on a one-on-one call with you to go over specific questions. This video is more, I mean, you can call it a hype video or an intro video. I think it's just a great thing, as it's just another tool in the toolkit to round out the marketing for an opportunity. And what's really special about Grand Riviera and the video here is that it's not our first, it's our second 506c opportunity, so we're able to be public and talk about it on forums like this. We're able to post videos on social media and talk about it on social media. So it takes on definitely a different element in that regard, which is a fun experience.
Yeah, no, I think it's super cool that we get to talk about this deal so often. And what the other really cool thing for me as well is to see is we were able to publish our webinar not on a private link, but a public link, which went directly to your YouTube page. So to see just the amount of views that video is already getting is really, really fun. We've gotten very nice feedback on that webinar. We've gotten very nice viewership, a lot of shares on it, so that's been very fun to see. So I assume that Grand Riviera similarly will get that. I believe by the time you're watching this, it'll be spammed to your inboxes, to your text messages, everywhere. So hopefully you enjoy it. And comment below if you like it. Comment if you want to see anything different about our content strategy and whatnot. We're really looking to kind of focus in on a couple more strategies. We like kind of what we're doing currently, but we're always looking to improve. We're not looking to reinvent the wheel. We're just trying to do what works. So would love to hear kind of some of your thoughts, what you'd like to see from the consumer perspective. And I think the best tweak, as you alluded to, was just basically condensing the video, really high level facts, not a 2.0 glorified webinar in person, but a nice, concise, sub 10-minute long video would be great. Speaking of that as well, content strategy. So I'm curious to know kind of what direction you want to go with for content on our end. We've obviously done a lot of our episodes with our great team with exclusive video productions, but I'd be curious to know what you're looking for moving forward, what will work, what will change, what we'll do. So floor is yours to kind of unpack kind of what your thoughts are on that subject right now.
Yeah, well, going back to the property tour videos, and if people don't know what we're talking about, I encourage you to go to just click on our YouTube channel and check out the Grand Riviera property tour video, and you can probably go back and see some of the older ones as well. I'm not sure. Now that we've closed some deals, we can probably go back and make those videos public. So that's something to consider. So anyway, these videos really were a test. We decided to give it a test. They don't have to be here to stay, and I feel like they're fun to do, they're cool, but I'm not sure, if it's not a 506c, I'm not sure how much it actually moves the needle. So that's something that we need to test. And the other thing that's tricky about these videos is they take a while to produce. We have to coordinate with everyone, the on-site team. We have to, me and you have to get on site. Our video team has to get on site. Then we have to record, and then our team has to edit. We have to approve the edits, and then we publish. It's a long timeline, and unfortunately, typically deals are a shorter timeline. And also, that's one of our goals. It's not priority number one, but one of our goals is certainly to improve our processes such that we can close deals in a more timely manner. So if we're waiting for a video to be edited and to come out and everything, it just may not be conducive to a 60-day closing timeline that we're striving for. So I think these videos, they're fun to do and I like them, but I'm not sold on them completely. I feel like they need to work for us, not us work for them, right? There's no
Right.
reason to just add extra work for us for no reason, right?
Well, I will say one of the benefits to us going in and doing the video, I would say, is it does signify, hey, we have seen the property, we know what the area looks like, we've done our due diligence, and here we are on site. So for two people who don't live in Texas, at least historically before, now that's a different story, it does kind of convey a nice story that yes, we've been here, we're doing this, we're doing that, we're taking the right steps, we've seen the property, we've gone through toward the units, and here's us doing that. So as silly as it sounds, not that we don't have, more qualified people doing that, like our people at our property management company, and other very valuable assets like Brad Oliver, who's doing the underwriting, who knows the numbers cold, is kind of overtaking some of your roles there. It's funny, but people do still want to have us do that because, I think there's sometimes misnomers thinking that you and I kind of do all of that kind of work on that end when we actually have a very detailed and robust team where we divide and conquer responsibilities.
Yeah, it's kind of just a little bit of an assurance. Oh, these guys are on site. This is a real asset, right? Because think about all the scams that actually have occurred, right? There's stories and situations. Legit investors have unfortunately fallen for these traps and scams, but situations where the sponsor was claiming to buy real estate and then never actually bought the real estate and just took the money and ran off. Or I don't know, there's just a ton of stories like that. So, you and I are in the weeds of the business and trying to put together the best investments possible for our investors when and so we're kind of tweaking everything, and is the debt structure just perfect, and do we have the business plan right? And then sometimes in the back of an investor's mind, all they care about and think about is this a scam, right? So I mean, this is kind of a different topic, which is funny, but it's it's the truth, right? So it's an interesting thing to think about, that something as simple as just, hey, here we are, we're real people, we're at the property, this is a real property, this is not just a financial instrument, this is not a scam. Not that we say those things explicitly, but I think, like you said, a video like that certainly conveys that.
What was super funny, what brought my mind to is Tate Dierier, our good friend and capital partner, said something so silly when we were at our dinner at Best Ever Conference. And I don't remember if you remember this quote, but he was raising money from his uncle. And his uncle asked, so just a quick question. Are the cash flow coming from the next investor's dollars or from the deal? He's like, oh no, from the deal. He's like, yeah, I know, I'm kidding. I'm asking you if it's a Ponzi scheme, just as a joke. But it is certainly, in the internet money world of things, it's certainly a very valid question. And I think more and more as time goes on, we're going to see a lot of frauds kind of occurring as the economy changes, as the game gets on hard mode, as things kind of get tightened and the economy gets weird. A lot of scams and frauds, unfortunately, do become exposed, sadly. So we're kind of in the season of that occurring right now. We've obviously seen a lot of those things occur elsewhere before. Did you show me something? Because if you did, I could not see it. But
Oh, you can see it. Tate texted me yesterday with Sam.
oh, I love it. Very good. Yeah, of
Yeah.
course they were out and about.
So
Yeah.
yeah, Tate didn't even say that he was in New York, but Sam's staying at my place, and so Tate texts me a picture of them, and he says, "We're throwing a party at your house."
I love that. Yeah. Well, I saw on his Instagram, actually, as a matter of fact, that he was going to be in New York. So I was very bummed out to not be there with them. But
Yeah.
nevertheless, it's always great to have your buddies message you, come into town, think of you. It really is special. And that is actually just now that we're really getting railroaded here, but and off track. But love one of the reasons I do love this business is because you actually do develop some really cool friendships and relationships, people that you would actually want to be friends with. And those are two people that we've become friends with over time. So very special to combine, relationships where we can do business together, laugh together, and make money together. So it's all special there. But yeah, going back to content strategy, moving forward, ideally, TikTok might be going away. We don't really know short term, long term, medium form, content, short form, medium form, long form content. What do you want to think you want to do, as we kind of keep going? Because we're almost a year into this. I do think this has been very successful. I think we're ahead of schedule, but we always want more. So just ideally, if you could put a bow on it, what is, I guess H2 for 2024 and 2025 and beyond horizon looking like?
Marketing content wise, I think we're doing awesome. I think we're firing. We've got a great team as far as marketing, as far as editing, production, content creation. So I'm really happy with how things are going. And I think I think the biggest opportunity is putting fuel on the fire via ads. I think we have gotten to that level where we've graduated to running ads. And so we're testing that out now for the very first time with Grand Riviera. Obviously, ads are a very complex and competitive and expensive game. So it's not like you just press a button and all of a sudden you get way more leads and everything is just, putting that fuel on the fire is a skill in itself. And so we have to learn it to some extent. We have to work with the right partners. But I think that's the low hanging fruit. That's the big opportunity for content for us moving forward.
Yeah, I couldn't agree more. And it's exciting on my end to see that because if we do convert these people, the said individual who's going through the ad or capital raisers, once it gets to the second deal we do with them, we do another one. It's basically an infinite return point there, right? So if we can convert these, if we can, do that, it's just very, very lucrative, obviously, but as you said, competitive. We're not anticipating this to be an easy cookie to crack, but we're gonna put our best foot forward there. And the crazy thing is, I'm sure running ads during 2021 and 2022 when money was really hot was a lot easier. Now that people are a little bit snake bit by just basically the economy, the market, and dollars are tighter, it's probably harder than ever. But maybe you can make an argument that since the economy is very difficult, that perhaps it's the best time to run ads because other sponsors and firms are not. So if we kind of, put gasoline on that fire there and really, be very intentional about it, perhaps we can, get outsized returns. So there's arguments on both sides of that. Moving on to outsized
Real,
return.
real quick, nuts crack, cookies crumble.
What's that? Tough nuts guy. Yeah. Okay. Very good.
Yeah, yeah.
Yeah. Moving on to the next subject here, groupthink. So I know you've got a lot of thoughts on this one, and I would love to hear your perspective on that.
Sure, yeah, this is an interesting topic. So, just to set the stage for people, because we have a diverse audience, so not everyone is, uh, you know, directly in the business. So, but in our business, we have it's a lot of participants in the real estate investing space that their primary activity is raising capital. So they focus on cultivating investor relationships, and then they raise capital, and then they basically act as a fund manager, and then because they direct that capital into sponsored investments like the ones we do. So a lot of the money that we raise is not just from individuals, but it's also from these syndicates and these fund managers, right? And we call them fund of funds. They can also look like co-GP partnerships. So there's that. So it's a very fast growing segment of the market, and because let's just face it, raising capital is extremely lucrative if you can do it right and well, and it doesn't require all of the infrastructure and brain damage of actually building up an entire real estate private equity company like what we've built at Lone Star Capital, which includes acquisitions, due diligence, asset management, property management, construction management. I mean, we're talking about, this is something we can talk about later in the show, but we're talking about like property management is the worst business in the world. And nobody wants to do that. So if you can just, and it's not well paid too. It's very poorly compensated, which
It's
actually is
not
what.
fun, it's not sexy, and it's actually why people, probably actually get out of owning their own deals because of the property management side. Everyone wants to own real estate. No one wants to operate asset management, property management. It's very, very tight, and it's very time or it's very time
Consuming.
heavy. Yeah, it's very time consuming and it's very low ROI.
Yeah, that's exactly right. No, you point that out very well. Yeah, investors come to us all the time that are professional investors. They have their own portfolio, but they are tired of being an active landlord and they want to sell those assets, and they often tend to do an exchange into deals with us into now a more passive role while still getting the benefits of real estate ownership. But anyway, that's a bit of a digression because the point is that's very time consuming, very difficult, poorly compensated. Whereas capital raising, I don't want to say it's easy. Capital raising is not easy, but
And it's never been harder either, might I add.
true, true. But at least you get to sit back comfortably and you get to go on lunches and dinners and you can do podcasts and you can talk to investors and stuff like that. So it's a bit different. But anyway, so the space has grown tremendously with a lot of people being interested in raising capital, which then they pool together in these fund of funds and syndications and then invest in deals like ours. So what we've now noticed is because a lot of bad deals got done in 2021 and early 2022. And now you use that term snake bit, which I don't think a lot of people really understand that term or what that means, but basically people are having a bad experience with deals that they raised money for and invested in 2021, which is now causing them to act differently. So what do? One thing that we've now seen has grown tremendously in popularity is capital raising partners group together to kind of share deal flow with each other, share due diligence, and really what they're doing is they're trying to not look stupid. Investors, and this is something that you see from top to bottom, from the entire spectrum of the investment universe, you find that a huge, huge concern, and perhaps the number one concern, is to not look stupid. And the funny thing about not looking stupid is the way that you look stupid is by going against the group, going contrarian, right? But we all know that being contrarian is the way that you actually make the most money in investing. So it's a very funny paradox, and this is what makes investing so fascinating and so difficult, is because it is against human psychology to invest well. And with these new groups that are forming, these masterminds or these cliques or whatever you want to call them, of people that want to share knowledge together and raise capital, is what happens is they form together, which creates groupthink. And so now the loudest voices, not necessarily the smartest voices, but the loudest voices kind of commandeer this group. And if the group makes a decision and says, well, we think that this is the right decision, it's very difficult for one person in that group to veer out and go against groupthink, because now they're going to look like a pariah, they're going to be contrarian, and if their decision is contrarian and then it's a bad outcome, then they're going to look stupid, and it's not worth it, right? It's not worth the risk. So I think the main point here, which is, I don't think it's net positive for the industry. It's definitely not net positive for the industry, is that as a sponsor like us, if we were to go to an individual person who raises capital and we say, hey, do you want to partner with us on this deal? And if we go to 10 people, maybe we get half of them to say yes, and they want to partner with us. Well, if those 10 people now form into a mastermind group, and then I pitch the entire group on the deal, if the consensus from the group, whether right or wrong, is to invest in the deal, then we'll probably get all 10 to invest with us, which is amazing, right? But if the consensus in the group is no, then that's going to get every single one of those people to say no. Now we get zero. So it becomes a binary outcome. We get all or nothing from these groups, which then basically now drives all these partners and investors into the arms of sponsors and deals that may not necessarily be the best deals, but the deals that somehow crack the code or crack the nut of the group and what they're looking for.
Very well said. And my thought is, I guess your preference, which I'm assuming you kind of answered it, you'd rather basically, let's say if you have 10 people we're pitching to, you'd rather five say yes to each deal, not all 10 say yes to one or none, right? So you'd rather have there be an equal balance throughout just to help our end. I understand both sides of it. I guess to you, where is it the stickiest? Where is it the best? Where is it the worst? Like the good, the bad, the ugly of that. Because there has to be some pros, there has to be some cons. So can you maybe just unpack what you like, don't like, and where you think the biggest problems lie?
Yeah, I think the problem is just the groupthink element. I don't think it's healthy for the market for these binary outcomes that are led by not necessarily by meritocracy or by the best decision making. So, because as we know in a group, it's not necessarily the best ideas that win because there might be a particular influential person in the group and they are going to steer the group in a certain direction. So, yeah, I don't think this is enemy number one and the biggest thing. It's just an interesting thing that we have observed as the market has matured, as we've seen these different groups form. And I don't think there's really anything that we can do about it. I don't think we can kind of shed light on this issue and people are going to wake up, right? It's just psychology is so strong, groupthink is so strong, so it's very difficult. I think what it means is rather than us complain and say, "Oh, this is not right," or you know, I don't want to play this game of this binary outcome. I think we just need to step up, right? And it's like everything in life, and you and I talk about this all the time. Let's not complain about the game, right? Let's just understand what the rules are and let's play by the rules and let's play to our advantage. So I think this is a great opportunity to just play by the rules. These groups are forming. Let's approach these groups and let's do what we need to do in order to win over these groups.
Yeah, and I also think the best thing too is abundance mindset. Hey, a no from someone is going to get you a yes from someone else. So, find folks who will say yes to what you're looking to do. And this is why I'm going to all the conferences under the sun, seemingly in the commercial real estate world, to find more equity partners who may say yes to our opportunities. No matter what the vintage may be, no matter what the return profile looks like, we want people that will say yes to us only if it's a 20 IRR, and we want people to say yes to us only if it's a 10 to a 13 due to the fact that that's what their fund structure or maybe what their limits are, or maybe they're a little less risk, maybe they're more risk adverse, right? So it's up to us to find the yeses, not complain about the nos. You don't get anywhere in life by complaining, sitting around, or feeling sorry for yourself. We're just going to rise above it all and make it happen.
Yep, that's right.
Yeah. With that said, we'd be curious to segue into kind of your perspective on H2 deals. So, second half, H1, H2, for those who don't know. H1 stands for first half of the year, H2 stands for second half of the year. With that said, for the second half year of the goals, what deal flow, or I guess deals, do you think you want to target? Because I know my answer, but on your end, be curious to know and for you to share with the audience kind of what's kind of coming down the pike, what we'll say yes to, what would most likely kind of end up being in our lap that we'll kind of say yes to as, capital's going to get tighter and frankly operations aren't going to get any easier as well on the takeover process.
Yeah, I think we've done a great job so far this year, and we're remaining active and buying high quality deals. I would like to see us continue to focus on buying just nicer quality deals in general, and I don't think that's even necessarily a commentary on what's best to do in the market today. I think it's just what's best for us as a company as we mature, and also in my new role as COO and being deeply involved in the operations, I think that's also going to be very instructive and inform my CIO hat of investments and what should we be buying and what do we want to be buying. So yeah, I'll have more to say on that as time goes on, but I think that it's still a great buying opportunity right now. Cap rates are still expanded, and I think that we're going to see rates come down towards the end of the year. I'm not so sure that that's going to all of a sudden usher a ton of liquidity back into the market because I think that fundamentals aren't going to be super rosy, right? When rates are low and rent growth is high, that's a frenzy. Everyone's going to be just jumping into the market and they can't help themselves, right? And that's what 2021 was. So I don't think there's really going to be much rent growth until about 2026. So I think in But it could happen even a little bit sooner. But basically, I think now there's a good window where there's a bit of pessimism. I mean, you tell me, right? If you go online, on LinkedIn, if you talk to people in person, if you go to events, I feel like people are still pretty pessimistic. And when people are pessimistic, that's the time to be active in the market. So it's funny, a few weeks ago when I posted on LinkedIn about how cap rates are likely to compress and how we were modeling that in certain circumstances, obviously conservatively, and the deal pencils even if you don't model out the compression. But it was definitely a bit of a salacious post. We knew that it was going to be controversial, but yeah, it got people really going, and it showed me, it really validated the truth of the post, because you had smart people, you had tenured people in the business, people that control hundreds of millions of dollars of activity, right? These are real buyers in the market, and they control capital. And when you have them all painting this picture of pessimism and their underwriting is very pessimistic, that's keeping that liquidity out of the market. And so prices are just a function of capital flows. And so, what do you think is going to happen when the sentiment changes and everyone all of a sudden gets really optimistic and is pouring capital into the market? What's going to happen to cap rates then? They're going to drop like a rock, right? So it really is self-fulfilling or self-evident that cap rates are high right now because of the pessimism and lack of capital in the market.
Very interesting there, and I really appreciate the detailed breakdown. I guess my thought is, and number one comment is, and I think we said this the other day, but scared money doesn't make money. And the other thought is you want a dollar cost average your dollars into the market, right? You want to kind of, put out, let's say you had $1 million plopped in. It wouldn't make sense to go all in on one deal. You'd probably, pace it out, maybe X amount per here, 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 and kind of let it go. That's kind of how we look at buying deals. We want to buy deals in every point of the market, put on a good, fundamentally sound, logical debt and equity structure to make sure that no matter what the market where the market goes, what happens, in the economy, whatever, that we will be at least sheltered to a certain extent to any potential volatility. But the other thing to think about is I think also just kind of rhymes with groupthink, right? Well, if every big institution is throwing out capital, guess what? Those people more pessimistic would be forced to put out capital because their investors wouldn't be there and they don't get paid to look at money. So, I'd be curious to know if there's people that are more pessimistic, if they're putting out money where they are. Do you have any theories or hunches on that? And this is from an institutional level, by the way. This is from the, big groups that, raise, 250 million to $1 billion funds that they got to deploy from, opportunistic funds, so on and so forth, for some context.
Yeah, well, I know you're having those conversations as well, and perhaps more than I am. So I'm sure you're hearing that a lot of them are looking at pref opportunities instead of common equity, which, I think pref is always interesting if you can be on the lending side of that. Otherwise, I don't really know. I think that they're being just they are being conservative. They are conserving their dry powder. One thing for sure is the focus on newer vintage, and I think that's a really smart thing to do, especially if you do truly have a ton of capital and you don't need to be super levered. I think going in really low leverage is a really smart thing to do on these new assets that are basically being sold by the developer, where you're able to buy below replacement cost. Being able to buy below replacement cost is really, really special when you're talking about newly constructed assets.
Well, and this is kind of interesting. It made me think, and it's funny we kind of arrived to a similar conclusion. That little reel that I sent you pertaining to Barry Sternlicht, who's basically said if you can buy with positive leverage and below replacement cost, it's basically very challenging to not make money in the marketplace. And I agree. The only thing I almost take issue with is, wow, it must have been really easy to play the game on easy mode before, multifamily real estate became incredibly institutionalized and more stable, where you could buy, in really good growth markets on positive leverage below replacement cost. Because guess what? You were not doing that in Dallas. Like, that's just not realistic. You could buy below replacement cost in Dallas, but to couple that with, a positive leverage, no, that's really not realistic.
Right, you can get one today, but not both, right? You're able to buy new construction assets below replacement cost, but you're not going to get positive leverage.
Yeah, and it's kind of interesting because it seems as if everyone's looking for unicorns in the marketplace, as are we. But when they say this and I meet them for the first time, I don't know if they're just basically seeing if it's almost like a you know what test, kind of an S test, or if it's going to be yeah, we'll say this, send us our deals, but we're basically saying, hey, we're not going to work with you now. We're going to work with our friends who we've given a bunch of money to because we'd rather do that with them as opposed to try out something new and look silly and get fired, right? So that's kind of what their role is. And it was very interesting too. I remember when we had dinner with Christopher Mendez with Promark at Cipriani. He said, you know what? My favorite thing is sometimes is when IC tells me no, and I report to IC telling them that this deal was actually double the expectations and they made a bunch of money. I love reporting that back to them, and I look forward to you guys doing a deal really well. Me telling IC, look how well they've done. He's like, but the thing I've pride myself on is never losing a dollar in any deal, and that's an impeccable track record. He's never been capital called. They've done very well in every single deal that he said yes to. So it just goes to show, the bar is set very high with a lot of these very intelligent people. But it just goes to, the point that, groupthink is for sure there. And, the threat of losing money is more painful than winning. I think a lot of times in life, losing hurts a lot more than winning feels good. I think
That's
that's
exactly right.
that's a very big driver in life. So yeah, I think H2 goals for deals, is kind of, with all that said, to put a bow on it. I've kind of said to our people just internally, with kind of raising dollars being harder, if we can steer closer to 90s and 2000s vintages, basically 90s and newer, like everyone else, that will probably serve us well, at least for the foreseeable future. Perhaps we can get paid if we do a deal like Grand Riviera, which I know we're going to get paid on. I think it's a very good deal. But with that
Can you
said,
explain? Can you explain what getting paid on means?
yeah, getting paid on, yeah, great point. So getting paid on a deal means if I'm going to buy a riskier deal, I expect a higher return. So let's take, for instance, the San Antonio deal we did, Aspire, which I think the apartment name is changing soon, but the first deal that we acquired this year in San Antonio was an 80s deal. It was a C-class property. It had certainly some issues. There was distress on it. Well, we took that deal on because the IRR and the economics looked so good. We knew that for our headache that we were going to accrue, that there would be a big reward on the back end of that opportunity. So that's what we mean by getting paid on an opportunity.
Yeah, you want to get paid for the additional risk that you are accepting on the deal. Otherwise,
Abs-
if you're going to take on basically the same, if you're going to get the same return, you might as well just buy a less risky deal.
Yeah. And speaking of buying deals, speaking of Texas, let's talk about your goals with Houston, kind of your update there on your journey. I think you just got into today, so as time unpacks, we'll have more information there. But I think you've probably had a lot more time to think about this over the last, 2 weeks or so, and even from last when we spoke on this change. Be very curious to know if you have any updates, what you're kind of thinking, feeling, what you're experiencing in real time.
Yeah, so I got into town on Saturday. It's now Monday, so my mattress hasn't come yet in the apartment I'm staying in at one of our properties, and so I got a hotel. Life is good, everything's good. Houston's great. I'm super excited about this new chapter and new challenge. I'm not gonna share the whole roadmap because I just, I'm still working on it and want to be careful with managing expectations, but I'm super excited to be taking over in the COO position and really just spread the Lone Star culture throughout the entirety of our company. And with that in mind, something I'm really excited to roll out is we're changing the name of our property management company from Radiance Living to Lone Star Communities. And this is an effort to bring down the walls and the partition between the private equity side of the business and the property management side of the business. And so previously we've had Lone Star Capital, that's our company, and then we created Radiance Living as our property management entity. Well, as we've grown, and we've grown a lot, these two entities have essentially grown independently and they just coexist by virtue of owning and managing property together. But they very much grew kind of separately. And so I feel I feel regret and I want to change that and I want to change the culture for the entire company to feel as one company. And so symbolically, we can achieve that through changing the name to Lone Star Communities. And then in practice, the key ways to change that are through communication. Obviously, if we want to not have barriers, we all need to be talking, we all need to know each other, we all need to work together, we need to disseminate the Lone Star culture that comes from the very top throughout the entire company and not just end in New York in the Lone Star office, right? So communication, which means, the daily meetings that we have, the weekly meetings that we have, monthly meetings, right? Incorporating everyone as appropriate into that communication flow. And then from a technology standpoint, I'm really excited to be rolling out new technology because, like I said, as these two companies have grown in tandem, our property management company is working in teams and has different systems and different technologies, and then Lone Star uses Asana, Zoom, Dropbox. So we're looking at this web of technologies and ways that we work, and I need to bring it all together. So that's something I've been working on, and I'm excited to roll out. That's just going to be, I know this doesn't sound super important, but I'm confident that it's the first step it's a first very important step that's going to create a ton of value. So yeah, I'm not trying to, Rome wasn't built in a day, and I'm not trying to completely change everything overnight, but I think there's a lot of opportunity for growth and improvement on the property management side of our business. And really, this is an important step that's going to allow us to not just perform better today, but it will prepare us and put us in a position to be successful for the continued growth that we're going to experience as we go from around 20 properties to 100 properties in a handful of years.
Yeah, no, our growth is going to be very rapid, and with growing becomes pains. So we grew, now comes potential growing pains. So I don't think pain is almost sounds like it has a negative connotation associated with it, like a negative kind of thought there, and I don't want that to be the case. But we've grown, and we want to make sure that as we even grow further, we start acquiring more and taking on more on our plate and being able to accomplish more. Because all of our lovely investors and our capital allocators who are listening to the show, thank you so much. We're going to need, just to tighten up and to put the best systems and practices in place as we go forward. I think you've said this phrase so many times, and I'll say it again. What got us here won't get us there. And we're just basically looking to cement our future even further and make sure that we are allowed to scale correctly and grow correctly. And one thing that I find very interesting, one thing that I am really excited about, and I think that is super unique, is really how lucky we are that you are young. Let me explain. If you had a wife and kids and had that going on, a robust family life, which you will hopefully, inshallah, have soon, you would not be able to just to leave on a whim like this and kind of move to Texas indefinitely to, put on, the next set of future plans for our company, for Lone Star, for your company, for your baby, right? So the fact that you're able to do this and you have the autonomy and the ability to make a quick and nimble decision, almost basically over on a whim overnight, speaks to how valuable it is. Actually, I would argue to be young and to have this the not all the bureaucracy of a family system to do that.
Yeah, absolutely. We're very lucky, and yeah, I'm passionate, and I'm not, fat and happy, rich in my ivory tower in New York, right? I'm here at the properties on the ground, and I'm going to be making it happen. So it's a great journey. It's a great story, and I hope to turn this into a story. And wink, wink, this could very well be the fodder for my third book. So I think that could be very exciting. So it's all very good stuff.
Amazing. Well, speaking of which, you'll be living at one of our properties. So, as an investor, I'm very excited about that. So, you'll be over to take over the or you'll be there to take on the takeover process, kind of walk through that. So, have you kind of seen that happen in real time? I mean, obviously, you've been in Texas before for long stints during COVID, if I'm not mistaken, you did that. But have you kind of seen that property and that kind of change and handover in real time before? What's your experience with that?
Yeah, for sure. I think it's very satisfying to see a property change because in some ways you can look at a big 300 unit apartment complex and it can look and feel like an immovable object, and you think, oh my gosh, how would we ever get occupancy up, or how are we going to raise rents, or how are we going to renovate all these units? And so it's very satisfying to see those case studies and success stories happen. It really is possible that with the right effort, with the right team, with the right marketing, you actually can go from 80% occupancy to 95% occupancy. And you can renovate units, and you can cure deferred maintenance. You can clean up crime. Crime is an endemic issue sometimes at a property, and that can seem like a very daunting task to clean up, but it certainly, all these things are possible.
I love that. Well, final thing I want to talk about, we'll save some juice for the next episode. Something that you're wearing right now today, we'll obviously end it with a little watch talk. You want to talk about the new piece you have to the edition. You moved to Houston, you're in a more modest environment. Now you have a more modest, beautiful little timepiece there. Can you maybe take it off the wrist, show it to the camera to unpack your new baby that you're getting ample pleasure out of?
Yeah, well, I'm definitely not an expert on Seiko, but this is a beautiful Seiko 5. I'm already forgetting the reference number. I feel like it's a SNK 805, I think, but it's obviously the green. You got the green dial with the green
The
strap,
Kelly Green. The
the
Kelly
Kelly
Green.
green. I think, I mean, this is so much bang for your buck. You have open case back, so it's an automatic piece. It's not a screw down crown, which I like. However, one thing I don't like is you can't wind the movement through the crown. The movement only gets power from your wrist, right? So from movement. So you know how other watches, obviously, you can wind the crown and that will generate power that will wind the watch. So in this case, this winding does nothing. But yeah, I think this is a perfect. I think the like matte steel is such a cool look, and I think this watch will look even cooler as it gets more beat up. So perfect field watch, perfect watch to be working and making things happen on the ground. Also, it's so hot and sweaty in the summer in Houston, so no leather bands, right? Leather's gonna get sweat right through, so you gotta wear something like this. I think this is a cool strap. And also, guess what? This is a day date. You got the day and the date here. So I've got a day date right here.
Yeah, that rivals the perpetual, or sorry, the presidential, right?
Exactly. Exactly. So I
So,
think,
al-
yeah, good.
also a question for you. Now that you're in a driving city, you didn't have a car in New York, obviously. I think it's funny when people ask you, "Oh, you live in New York City? Do you have a car?" It's like, no. The parking would be more expensive than the car payment, and you wouldn't have a cheap car payment either. So, with that said, or lease. So, with that said, what did you elect to pick up for your mode of transportation? Did you Toro it? What medium did you get it on? Maybe unpack that. A little lifestyle talk here.
Yeah, yeah, this is actually an interesting topic. So we went ahead and chose Sixt for the rental car. Shout out to Hannah in our office for sorting that out and finding a good solution there. So Sixt, downtown Houston, long-term car rental. I got a white Toyota RAV4, and it's perfect. It's everything I need. As long as it has CarPlay, I'm set. So that was my only requirement. Is I needed here are my two requirements that I told Hannah that the car has to have. It has to have USB-C ports, and it has to have CarPlay.
See, I'm a little disappointed it's not a truck. I would love to see like a Toyota Tacoma or something like that. And as Kanye West once famously rapped, what do you think I rap for? And you won't use any explicits, but what do you think I rap for to push a rap for? So with that said, thank you so much for listening to the Lone Star Capital podcast, almost a year deep in the making. For those who have left, we hope you come back to the show. Not that you'll be listening to this. For those who have stayed from the whole time to watch my transformation of being a dude with highlights in his hair, with a heinous haircut, a little bit heavier, and a lot less world knowledge and experience to now, we appreciate you sticking through the good and the bad, and seeing the improvements from me interrupting every sentence to maybe only a couple times a show now. We're still working to get better at it. I know a couple weeks ago I was pretty bad on it. Maybe it was a little bit jacked up. Maybe it was a little bit of the internet connection. Who knows? But I'm working on it a lot. This show has provided me a very big improvement section to my speech, to my language, the whole nine. It's funny, when you put yourself out there a lot, you will most certainly get the scrutiny, but you will get better. So I'm very grateful for that. For the lovers and the haters, we appreciate appreciate you. For everyone who's listened to this episode, we really appreciate it, and we'll see you next week in person in Houston. We may have a special deal coming our way there, so we don't want to talk about it yet. It's too far away, but we got stuff coming down the pike that I know you'll be interested in. So if you're a capital allocator, if you're an LP investor looking to invest with us, you know how to reach me. And if you could please leave a comment, like, subscribe. If you know someone that might appreciate this, share with a friend. Long-winded exit, but we appreciate you. Everyone, take care. Happy Memorial Weekend. Peace.